Welcome back. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with John Zechner. John, talk to us about your concern that the so-called wealth effect may be losing steam.
Yeah, concern and worry, Paul. I'm a real killjoy here. But yeah, for the last couple of years, I look what surprised me in the markets, and I always sort of look back and why. And I thought economic resilience, particularly in the U.S. over the past 2 years, I thought was very surprising, especially given the rate increases we saw back in 2022. And we saw weakness in Canada. We saw weakness, across the global economy, not as much in the U.S. And why was that? And I thought, well, a lot of that was really the wealth effect. And you look at it, the U.S. stock market was around 140% of GDP, which is massive historically. I mean, in the 80s when they had this run, it was about 40% of GDP. So as the stock market in general rose, people felt wealthier. And as they felt wealthier, they continued to spend. And, so many people, you had the highest level stock market investment ever in the U.S. Over 70% of wealth assets are in stock. So, there's a lot of money invested there. So this sort of became almost a self-fulfilling prophecy. Stocks went higher. People felt good. They spent more money. The economy did better, which helped the stock market and a self-fulfilling role on the upside. So I was always curious, okay, what if it starts to roll over? If the stock market, for whatever reason, hits a peak and starts to go down, what's going to happen? Are you going to have the economic effect going in the opposite direction then? And instead of stock market keeping the economy growing. So we saw that in the back half of December. We had a soft stock market. You didn't have the Santa Claus rally. You had a couple of bad weeks. January started off a little slow. And I said, I really want to watch the economic data, the consumer data in particular, in January and see how it starts to roll out. And in that case, you know what? It's really showing off to the weak side. Look at the consumer confidence reports, what we saw from the Conference Board, from the U of Michigan surveys. They all dropped well below expectations and well off from the peak. So that's a bit of, I think, this wealth effect starting to work in reverse. And then you saw from the retailers, look at Walmart and Home Depot and some of these guys. I mean, they may have hit on the numbers in the fourth quarter, but then their guidance was very soft going forward. So what it tells me is that, we've sort of tied ourselves to the fortune of the stock market almost too much. And if that's to reverse, you're going to see the negative impact on growth as well. And I think that's been more sustaining in the U.S. What it does in the end, it creates one more level of risk and one more level of worry with stocks in general. I think people have to look at that and that, well, how do you hedge that? Well, have some U.S. bonds in the portfolio. You got a higher yield right now. You got a 4.6, 4.7 still on, 20-plus year government bonds. I mean, that's a nice hedge, because if the economy does slow down, obviously they rally and they're a nice hedge against any stock market weakness. So, and then, maybe be a little bit, less aggressive on some of the cyclical stocks, and particularly with the terror risk and other things. So just like for me, I've always sort of watching for the warning flags. And to me, that was, it almost was too good to be true economically. And, there was a reason for it. And are we unwinding some of that reason right now?
Have we heard it from top executives on earnings call? Any kind of concerns about the consumer environment being affected by the stock market?
They don't specifically say it because of the stock market, but what they do talk about is consumer spending and reticence. And they'll talk about, because of inflation, because of reduced wallet size and everything like that. But, because they're not going to talk about the wealth effects particularly that way. But like I say, the commentary I'm seeing is mostly, oh, we beat in the fourth quarter, but, we're guiding a little bit lower, or a little, our expectations are not as high for the current year.
That's John Zechner and what is on his mind. Up next.